Okay, good afternoon, everyone. You're very welcome to today's transfer pricing session. I hope everyone is coping with our current state of being and staying safe and well. Just some housekeeping details before we get started. Just so you know how to participate in today's event, at any time during the webinar, you'll have the opportunity to submit your questions. To do so, you just need to type your question into the Q&A at the bottom of the control panel. So we will do our best to answer those questions and pick them up in our Q&A at the end. There is a dial-in number included in the invite. Should you lose your Wi-Fi connection and need to dial back in via the traditional way of phone. We will also be recording this webinar and we'll share the link with everybody afterwards so you can listen back if you wish. The plan is to keep this to 40 minutes, 45 minutes at most, and get people out in good time on a Friday afternoon. So I hope you enjoy the session. I guess just the origin of these lunch and learn sessions was to provide an opportunity to get together and informally bring people up to date in terms of the latest development areas in transfer pricing. And today we're talking about what's happening in transfer pricing globally and probably closer to home, how the regime is changing in Ireland. There's no doubt that the transfer pricing remains front and central to the tax agenda, and I think that's probably evidenced by the number of people we have registered for today's event. I think we are at over 400 people today, so our ability to have that slightly more informal session is a bit limited. That said, I think we're going to take you through all of the key transfer pricing issues that people are having to think about and people are working through at the moment. Just to say that while we will be touching on both of these issues today, we will be holding another session in the new year where we'll be talking more about strategy for preparing for and managing transfer pricing disputes and audits, as well as a more in-depth discussion on financial transactions with a particular focus on the arm's length nature of the quantum of debt and how to address that. There just wasn't enough time in one session to do all that justice today. I should introduce Noel Marr and Ian Clark. They are two of our senior directors here on the Irish transfer pricing team. They're going to talk through a number of key issues with you shortly, and we'll use some illustrative examples which will hopefully bring things alive a little for you, and they will do that shortly. Before they do that, I think I just wanted to give a brief overview of the landscape in transfer pricing, so those that are not as close to this have a better context, and I guess for a bit of a recap for those that haven't been as close to what the developments that have been happening. First and foremost, we now have the OECD 2017 transfer pricing guidelines. I think they're the widely established around the globe as the key reference framework governing transfer pricing principles. And it has been incorporated into law in many countries, including Ireland at this stage, and applies under the treaty in any event. I think what we're seeing is that tax authorities are interpreting and applying these rules differently in practice. We have seen some fairly aggressive positions asserted by tax authorities based on the principles that are in these guidelines. And I guess on the other hand, we have seen taxpayers use the principles within those guidelines to good effect in articulating their own transfer pricing policy and position, or indeed in rebutting some of those assertions that tax authorities are putting forward. We also continue to see, I guess, a lot of uncertainty in the international tax and transfer pricing world. We know that BEPS 2.0 continues to circle and hover around us, and one might say that with regard to Pillar 1 of BEPS 2, that there probably are as many questions at this point as answers. Still, despite the progress that the OECD has been showing on the point, I think consensus is probably what's needed, and that is going to take some time. And the US being a key part of that, are probably a reluctant participant at this point. And I think without that, it becomes a little bit more difficult, and dare I say it, potentially more complex. But I think it does continue to move forward, and I think it's a case of watch this space. I think, in the absence of reaching a timely solution around the BEPS 2 agenda, I think we may see more unilateral measures taken by countries. We have seen over time, UK and Australia, for example, on diverted profits tax. I think I saw last week HMRC in the UK had increased their transfer pricing tax take by £300 million in the year end to 31 March 2020. So that's up to 1.4 billion of additional tax take around transfer pricing positions, which is pretty significant. We've also seen digital services taxes, countries running with that, like Italy and Spain and the UK and France, for example. And I think you know, not to mention US tax reform. That's obviously a little bit more established now, but it's difficult to tell where that may go now. Obviously, Trump had taken a pretty hard line with France, the threat of trade wars with regard to digital services tax, which you know, slowed that down somewhat. But it'll be interesting to see where that goes now with the Biden administration. So I think it's a case of wait and see on that. I think just all in all, there is a lot of continued uncertainty and change at the tax regime internationally and at an Irish level. And I think, you know, there's plenty at stake, and Ireland obviously wants to have a strong transfer pricing regime, and I think it will need to do so from a reputation standpoint internationally. I think the MAP statistics are very interesting. I think they really show that up. If we maybe just show on the slide there that, you know, we're seeing that the 3 transfer pricing MAP cases were initiated every day in 2019, and this has just come from recent statistics that have come out from the OECD, I think, this week. That's a 20% rise year on year in the statistics globally. And more than 1/5 of those cases that were in the year-end inventory for 2019 are pending greater than 4 years. So it's complex stuff. It's very fact-based, and a lot of degree of interpretation of the guidelines and judgment required in reaching a resolution. The time to conclude those MAP transfer pricing cases on average are taking around 31 months. That's you know, a fairly involved process, both from the tax administrations and the taxpayers themselves. I guess the good news is that 85% of those MAPs concluded in 2019 fully resolved the issue. So that is positive coming out of some of these statistics. Just move on to the next slide. I'm going to show you a few very quick slides just to I suppose, demonstrate the point. You can see that the number of MAP cases now stands at around 3,735 just from a pure transfer pricing perspective. That's increased significantly. If you look at the second line, where the cases post 1 January 2016, that has increased quite significantly in 2019. If we move on to the next slide, we just see that the key players in terms of MAP inventory of transfer pricing cases, I think it's pretty interesting to look. We can see obviously India is fairly prevalent in that, and then the other key players that you might expect to see. What this graph shows is, I guess, is a trend over the last 4 or 5 years in terms of the number of MAP cases by country. And you can see that the old reliables in terms of the US is there, Germany, France, the UK, Italy clearly has shot up in terms of its number of transfer pricing cases over the last 4 or 5 years. You can see there it was in the sort of 150 mark, and it's shot up to over 650. So pretty significant change. Move on to the next slide. We can see that just from at an Irish level alone, obviously the number of cases is smaller, but there still are quite a significant increase in the number of MAP cases. I think the most interesting statistic that really I wanted to just highlight to people was the average time that it is taking to resolve Irish MAPs, which is essentially the mutual agreement procedure, which is a mechanism by which tax authorities seek to resolve tax disputes in relation to transfer pricing positions. Interestingly, if you look on the right-hand side there, for older cases, it was taking on average around 52 months to conclude those cases, quite a long time. When you look at the more recent cases, that's down to 11 or 12 months on average. So clearly a pretty good job being done by the Irish Competent Authority in resolving transfer pricing disputes. The next slide is really just to demonstrate the kind of key players that Ireland is involved with from a transfer pricing perspective. You can see Spain, UK, Italy, and United States are the biggest ones in terms of our MAP statistics. And during 2019, the blue bar there on the chart shows you that there was a number of cases between the UK and US, which are probably, you know, two of our major trading neighbors or partners. On the next slide, I just wanted to show 2 quick statistics. This demonstrates, I guess, it shows 100% success in terms of resolving transfer pricing cases. Really a word of caution here that the bit in purple shows that 60% of those cases were resolved where full agreement and fully eliminating double taxation, and the 40% was where unilateral relief was granted. The bit I'd like to just highlight to people is that these cases that would have concluded in 2019 could potentially be going back 4 or 5 years. So they may be old cases. There's a clear message, I think, coming from revenue, and we have experienced in a number of situations where where the taxpayer is seeking curative relief, which is essentially a refund, unilateral refund from Irish Revenue. There's been a strong resistance on Irish Revenue's part to that. They have resisted that in many situations that we're involved in, and really what's behind that is that where taxpayers have closed out audits in foreign countries without giving Irish Revenue, I guess, the ability or opportunity to maybe contribute to that process and negotiate on the principles, that they are slower to want to issue refunds. That's just a word of caution for people, that really keeping open MAP as an opportunity to resolving transfer pricing disputes is critical. The last statistic I'll show you was just to show you that it's a similar one on the next slide, which is around the UK, very successful in terms of ultimately resolving. Obviously the HMRC in the UK have been quite aggressive in terms of their positions that they've asserted from a transfer pricing perspective, but we are seeing that many of those are resolved. So on the next slide, the last thing I really wanted to talk about before I hand over to Noel is just an update for people to recap on what's been going on with the Irish transfer pricing regime. There's been an overhaul in the Irish transfer pricing regime. I guess the history is transfer pricing was only first introduced in Ireland in 2010, and I would say it's probably perceived to be a little bit light touch for the first 4 or 5 years. And certainly with the OECD initiative at a BEPS level, I think things changed in Ireland from around 2015 on, but we've really noticed in the last year or 2 years that Irish Revenue are becoming quite tough on these matters, and I suppose they are issuing fairly significant assessments to taxpayers for transfer pricing positions. And it's probably important also to note that this is not necessarily just in relation to more recent audit periods. It does go back to some of those earlier years where the transfer pricing regime may have been more light touch in terms of how it was applied in practice. So those 2017 guidelines are firmly in the law now, and Irish Revenue are using those principles in looking at taxpayer positions. I think a big change is the non-trading transactions that have been now included in the scope of the transfer pricing rules. That applies with effect from accounting periods beginning on or after 1 January 2020. Before now, we only had a regime that had trading transactions in scope, which were those transactions that are taxable at 12.5%. Obviously, non-trading transactions would cover stuff like financial guarantees, cash pooling. You may have trademarks or patents sitting in SPV companies that now are all firmly within the scope of the transfer pricing regime. I should mention, obviously, cash pooling arrangements and clearly loans that would have been non-trading loans in the past are now fully captured by the transfer pricing rules. The grandfathered arrangements, so prior to where transactions had been entered into prior to 2010 and the Irish regime was introduced, there were some grandfathered transactions still out there that might have been maybe management services that were being provided from non-trading companies to the rest of the group. They may have fallen outside the scope. And there are other examples. They are now firmly within the scope of the Irish transfer pricing rules. We now have formal documentation rules as well, and we'll touch on that a little bit more further in the session. I think we are brought into line with OECD requirements in terms of our master file and local file requirements, and those need to be prepared and in place contemporaneously by the time you file your tax return. So for many people, that is 7, 8, 9 months away, but most people are at the moment looking at their transfer pricing policies and seeing how they may reflect that in their documentation in good time. The last thing I'll mention is the domestic exemption, and when I say domestic exemption, it's inverted commas there. It is originally, when this was introduced into law through the finance bill a year ago, there was an expectation, I think, on everyone's part that it would provide for many domestic transactions, so Irish to Irish transactions. There were a number of conditions to be met. What we've seen in the last number of weeks was there was a new section introduced in the finance bill for 2020 that has narrowed the scope for where that exemption can apply to taxpayers. So there are many transactions that now come within the scope of the Irish transfer pricing rules. And we will talk about this a little bit more in detail in our next session. I should say that off the back of the finance bill a couple of weeks ago, there has been significant representation made not only by practitioners but also industry and some of groups representing taxpayers to the Department of Finance and Irish Revenue, with I guess a request at a high level to rethink the application of this, and not to unnecessarily scope in transactions that really are not a risk from a transfer pricing perspective. So that's kind of a recap of the Irish transfer pricing regime and what people should be thinking about. I'm going to hand over to Noel now to take you through some more illustrative examples, maybe just to bring some of this to life.
Thanks, Neil. So as Neil mentioned there on the last slide, one of the aspects that has kind of significantly transformed transfer pricing principles has been the development of the new OECD Transfer Pricing Guidelines 2017, which, as Neil said, are now formally adopted into our Irish transfer pricing rules. Those guidelines from the OECD have been significantly rewritten on the back of the OECD BEPS project. And I want to focus in on just one of the critical aspects that has pretty wide ramifications, both for specific IP structures, but also much more generally for even Irish PLC, Irish headquartered group structures. So really that key concept I want to focus on is this idea of ensuring that transfer pricing outcomes are aligned with value creation. So these new rules focus on two key categories of value drivers, which are relevant ultimately to practically all businesses, and that is intangible property and key business risk. So the rules require taxpayers ultimately to reevaluate contributions to IP and risk by looking beyond probably what we would have focused on as part of historic transfer pricing analysis, would have focused a lot on legal and financial contributions to IP and risk. And now there is much greater emphasis, much greater weighting on actual people contributions, functional contributions relating to the strategic management and control of IP and risk. So we're no longer, in the case of an IP company, we're no longer just looking at, does that IP company legally and economically own the IP? We now have a fairly significant substance test that looks at, well, does that IP company also demonstrate a capability and actually perform that capability in terms of controlling the IP and critical decision making? So what does that effectively mean? We're looking at evaluating senior management contributions typically and looking for key decision makers with respect to IP and control of risk. So the rules can be referred to as different things. Effectively, most people will be familiar with the terminology DEMPI of IP, which simply refers to control activities related to the development, enhancement, maintenance, protection, and exploitation of the IP. Even if you're not operating in an IP-intensive industry, the same substance rules do apply to risk and the control of risk across your business. So I've got two examples and kind of scenarios to talk through. The first is really what was in the crosshairs of the original OECD BEPS project, and that was low substance offshore IP structures. So historically, you would have situations where certain multinationals, in particular US multinationals, would have been able to hold IP offshore in a low tax, low substance jurisdiction like a Bermuda, Cayman Islands, or Bahamas. And effectively, there's been recognition that those old structures will no longer be fit for purpose in the context of this new substance requirement. So rather than trying to bring senior management substance to an offshore location, it has generally been the trend that multinationals have sought to unwind out of those offshore structures and bring their IP to a higher substance location. And from an Irish perspective, this has led to a steady flow of IP onshoring transactions into Ireland. We've been lucky enough to be involved in many of those transactions that are typically in the billions of euro of value per transaction. Now, it's worth saying that bringing the IP from a low substance or no substance location to a higher substance location doesn't address the problem in of itself, because it's not about having substance in your IP location. It's about having the right substance. So in this case, where you are migrating IP from a low substance location to perhaps Ireland, where you have existing principal substance or existing manufacturing substance, you still have to satisfy this test around, does the new Irish IP company, is it capable, and actually demonstrating control of that IP and associated risks? Some of the other considerations that we've dealt with as part of these onshoring strategies, which I think are relevant, whether you're onshoring IP into Ireland, and in some cases, even if you're migrating IP out of Ireland, I just want to touch on briefly. So first of all, in the context of bringing IP into Ireland, it is worth saying that an IP onshoring transaction, most taxpayers will look to avail of the IP amortization regime here in Ireland. Now, we have specific 291A IP amortization rules. The IP has to be qualifying IP, and the purchase price cannot exceed an arm's length amount. Now, again, as Neil referred to, capital transactions are now firmly within scope of Irish TP rules, and this is raising the bar on the amount of analysis and documentation required to support even an onshoring transaction where you're bringing valuable IP into Ireland. I guess the second and final aspect I would mention about these IP onshoring scenarios relates to valuation principles. And again, this obligation to ensure that you're adopting an arm's length price for an IP transfer, it's worth bearing in mind that the OECD have expanded their guidance on the relevant methodologies and principles that should be applied where you're transferring the IP from one jurisdiction to another jurisdiction. And again, I would direct anybody who is involved in either onshoring IP or migrating IP to make sure that their valuation methodology and critical inputs and assumptions are adhering to that OECD guidance. In particular, I want to just touch on a new concept in that IP valuation guidance from the OECD, and that relates to hard to value intangible principles. So just to break that down, effectively right now, what happens when a taxpayer is valuing IP, they are looking at the value of IP based on information available at the time of the transaction. You're assessing critical inputs, assumptions, and uncertainties at a point in time. Whereas when a tax administration looks to audit the arm's length nature of that transaction in 3 years' time, in 4 years' time, they actually have a new power now, and Irish Revenue have this power now, to actually rely on information that exists at the time of the audit. So they can use post-transaction financial data, commercial data to test the reliability of your critical inputs and assumptions into your valuation. And if they can satisfy themselves that there was a material deviation between a critical input based on post-transaction data, that can allow Revenue or another tax administration to make an adjustment. So it's really allowing tax administrations to use hindsight to challenge the robustness of IP valuations and onshoring transactions. If we move on to the next slide then. So the next example is more focused on a steady state structure. So following the onshoring of IP into Ireland, or even a case where the IP has always been in Ireland by virtue of being an Irish headquartered group. These value creation principles are just as relevant. So this is a fairly typical Irish IP structure here, principal structure, albeit it's simplified. We have an Irish headquarter, group entrepreneur bearing key business risks, owning valuable IP. Outside of Ireland, you've got related parties operating as relatively routine entities. So contract R&D hub, a contract manufacturer, and maybe you've got limited risk distributors dotted around Europe. Transfer pricing policy typically here will involve attributing most of or all of the residual profit back to the Irish principal or IP company, with routine cost plus or targeted operating margins being attributed to your related parties downstream. Now, in the context of value creation and the new principles around control, again, we have to re-examine all of these arrangements through this new lens of value creation and actually look beyond our long-standing maybe transfer pricing characterizations and legal form of these transactions to ensure whether or not any of these routine entities are actually contributing to the control of the IP or control of key business risks. Because if they are, a local tax authority in those jurisdictions can look to assert that they're actually not routine entities, and in fact also involved in making non-routine contributions, and therefore that may create an entitlement to non-routine returns or a share of non-routine profit that would otherwise be attributed to the Irish principal. So notwithstanding that you have a headquarters in Ireland and your senior management team might be predominantly based in Ireland, if you have pockets of senior management or key decision makers dotted around Europe in different entities, that's where you can create this problem where perhaps you dilute your control of IP or control of key business risks. And just to, what would a tax authority do in that scenario where they do identify a key contributor to control in a routine entity? I mean, a couple of options. They can adjust the price and say, well, that limited risk distributor should be getting a higher margin, or they can actually do something, I guess, a bit more drastic, and that's relying on an ability to actually disregard the transaction altogether or potentially substitute an alternative transaction. So that's known as recognizing the accurate delineation of the transaction. And it's just emphasizing that not only can a tax authority adjust the price, they can also actually disagree with how you characterize the transaction. So just to maybe focus on one of the transactions here, your contract R&D hub, that's typically a cost plus entity operating to perform contract R&D services. It creates IP, but for the value and for the account of the Irish principal company. Now, if a local tax authority determines that there are significant control contributions being made at the level of that R&D hub, at the same time, they argue that the Irish principal is not exercising control of that R&D activity and exercising control of the associated risks. A tax administration may well actually disregard the transaction altogether and argue that that R&D entity is in fact creating IP for its own account. And that would be a fairly nuclear option. And you may suspect, well, that sounds pretty far-fetched and it sounds pretty aggressive. Well, I've been involved in an audit for the last couple of years where Irish Revenue have taken a very similar position for an Irish R&D hub. That Irish R&D hub was getting cost plus 5, cost plus 10 for its routine service contribution. And Irish Revenue have effectively argued that the overseas IP company did not demonstrate to their satisfaction appropriate control of the R&D activity, and they're seeking to argue that that Irish R&D hub is in fact creating IP for its own account. So it's very much a real risk that needs to be, I guess, managed. So what are we recommending that clients do to take account of these new rules around value creation? Ultimately, it's about analyzing the actual activities being performed, looking at the conduct of the parties. Don't rely exclusively on legal form. Don't rely exclusively on perhaps long-standing characterizations. So just because we call an entity a limited risk distributor, does it actually act as a limited risk distributor? Does its management structure, does its decision-making capability reflect that of a limited risk distributor? So it's really much making sure we perform live annual functional analysis and produce robust TP documentation to support our characterizations. If we move on to the next slide then. So I guess the final piece for me before I hand over is, I think Revenue recognize a lot has changed, and that these new OECD principles, on top of all the other changes that have been made on the back of Finance Act 2019, is that further guidance is really needed from Irish Revenue, and they have been working over the last couple of months on draft guidance. We've been able to see various versions of it through TALC. Currently, that draft guidance runs to about 70 pages, but I think on the back of recent pushback on certain sections of that guidance and on the back of developments arising from Finance Bill 2020, it's possible that Revenue won't formally release that guidance until the new year. So I think for now, we'll still be in the dark in terms of forming our own views and interpreting the legislation as best we can. Just in terms of some of the practical items that are in that draft guidance, just want to cover off some of them, particularly around TP documentation. So as Neil mentioned, we now have a formal transfer pricing master file and local file requirement effective for FY20 and beyond. Irish Revenue do recognize in their draft guidance at least that benchmarking should ultimately be performed every 3 years, But within that 3-year period, you should be updating the financials on an annual basis. So just to be aware of that. Now, recognizing the local file technically is supposed to be an entity by entity local file requirement. Irish Revenue are indicating in that draft guidance that they may be willing to accept a consolidated country file for Ireland that may cover multiple Irish entities. Now, it remains to be seen how beneficial that is to taxpayers here when you consider that you'll still have to produce ultimately a functional analysis, economic analysis, and financial analysis for each of the entities, even within that country file. And finally, from a financial statements reconciliation perspective, Irish Revenue are saying that it's not sufficient to simply test the transfer pricing policy in your transfer pricing documentation. So if you have a cost plus 5 management services policy, you're not just testing and supporting the cost plus 5, you have to go further and show your application of that policy and how it impacts the financial statements of the relevant Irish entity. So can you show through segmentation and through reconciliation that you've actually applied your policy? Now, 2 other critical areas in that revenue guidance relate to quantum of debt rules related to financing arrangements, and also back to that Irish to Irish domestic exemption that Neil referred to. I'm going to hand over to Ian, who will cover those as part of his discussion.
Thanks, Noel. Yeah, so Noel introduced the topic of, or the concept of accurate delineation. And I suppose if I was to say anything, it would be that you should get familiar with that term as far as intergroup financing is concerned. Ireland's never had any sort of real thin capitalisation regulation or interest restriction up until now. But that has changed quite clearly as regards how the regulations sit at the moment. Neil mentioned 2017 guidelines are obviously in force anyway. We have, the OECD have released financial transaction guidance in February of this year. And obviously non-trading transactions brought into scope. So the net effect of all of that and how the revenue intend to interpret, particularly those OECD guidelines, is brought quantum of debt into focus in a way that has never been previously. And I've given 2 simple examples that I'm going to use to illustrate some of the points in this regard. One, we've got an Irish operating company borrowing from a Lux parent. And then another, we have an Irish asset-owning SPV also borrowing from a Lux parent. Now, the revenue are clear and correct that the 2017 OECD guidelines obviously are in force in Irish law. And from the revenues perspective, they're clear that that requires the accurate delineation of a financing transaction. From their perspective, they consider that to include considering whether the level of debt, as well as the pricing, is consistent with the arm's length principle. Because these are both Lux to Ireland and thereby treaty transactions, we also directly have to think about the financial transaction guidance as released by the OECD. That hasn't actually technically been brought into Irish law yet, but it has direct impact for any treaty transactions. And I guess almost more importantly, Revenue have stated that they're going to view this OECD guidance on financial transactions as best practice in any event. So regardless, or even if these examples had Irish entities as parent, we would still need to take that into account. So how do we do accurate delineation? And I guess even before that, when ought we do it? Well, from the Revenue's perspective, and I think it's logical, this ought to be done at the time the transaction is actually entered into. So it should be based on the results of the entity before the transaction, any projections that are in place, any knowledge that a notional lender would have had about the business model or transfer pricing model of the borrower. So just to give it a simple example, in this case, for example 2, we ought ideally to be thinking about this in 2015, not 2020. That obviously might present some logical, or rather some practical issues as regards actual data and so on, gathering it. Then as regards how does one accurately delineate? Our perspective is that based on the 2017 guidance, the accurate delineation really consists of 3 most important things. Firstly, to see if the debt has debt-like terms and conditions. Secondly, is the debt commercially rational? And lastly, can you price it? And from our perspective, if you can satisfy those 3 points, we ought not have to focus any further on the quantum of debt. If you then take into account the financial transaction guidance, which expands a little bit on the concept of accurate delineation, then we probably ought to also think about whether or not the borrower could borrow from a lending institution on similar terms. And then probably apply a wider lens around the terms and conditions of the loan to see if they look like debt, and when you consider the options realistically available to both the borrower and the lender, whether or not this loan would take place. And to give a simple example, can you really demonstrate that the borrower needs the money for its commercial purposes? What's not required by the guidance, we would say either OECD guidance, and there may be some confusion creeping on these points, is either needing to look at the financial covenants that are in place on any external loans within the group. So again, in example 1 here, we showed some covenants that the parent has on its external debt. Those, to be clear, any financial covenants in any external loan agreement are gateways to access cheaper sources of funding. They don't in any sense represent the limit on arm's length levels of borrowing, never mind commercially rational borrowing. The other point that misconception that's in place is that one ought to be benchmarking, say, the debt to equity level of a borrower before or after any debt gets put in place. That's, I think, incorrect on a couple of levels. Firstly, we don't think debt to equity is a particularly meaningful ratio. Certainly in the case of, let's say, an operating company. And it's obviously subject to accounting policies and so on. And the other point is that any concept of benchmarking a debt equity ratio is clearly then relying on industry norms and is departing a very long way from the question of what you could borrow on an arm's length basis. If you're going to have to think about ratios, then you really should be, first of all, thinking about those that are most in industry best practice. And in the examples we have here, we'd probably say for an operating company, we should be thinking a lot more about debt to EBITDA for leverage. And then in terms of some sort of cash flow measure, perhaps interest cover, perhaps debt service coverage ratio. For an asset owning entity, we'd be probably much more focused on loan to value in terms of debt capacity, and then also maybe looking at a cash flow measure, again, maybe DSCR or interest cover. So if we kind of look at these examples and see how they play out, on the face of it, looking at the debt and equity level, then you might immediately consider that there's definitely an issue here. But if we look at example 1, we can see that the actual debt to EBITDA ratio is 5 to 1. And 5 to 1 is a number I think that we would say this seems quite commercially rational. And actually you could probably make a fairly good case that you could borrow that from a third party lender. Secondly, the EBIT interest cover is 2 times. Again, that's not a level that would necessarily cause a problem to a third party lender. In the example 2, you first of all obviously need to be careful and acknowledge that the asset value may have been lower at the time the loan was entered into, which presents more challenges. But again, if you look at the EBIT interest cover, you would see that there's probably 1.2 times interest cover in place. And that again displays some potential to be a commercially rational arrangement. And then of course, in each sector, in each case, we need to think about wider measures of the financial strength of the business. So in terms of where we need to go from here, I think it's going to be necessary for any loan to look at accurately delineating the transaction. And that's going to mean reviewing the terms and conditions of the loan agreement, considering contemporaneous financial projections, contemporaneous financials. And probably if you want to be in line with revenue best practice, you're going to need to think about assessing the ability of the borrower to actually source funding from unrelated lending institutions. But again, that should be based on best practice ratios and not on any benchmarking, simple benchmarking. Lastly, I think we think credit ratings continue to be important in terms of providing initial very good example of whether or not you could justify accessing the bond markets to source this type of funding. So that's quantum of debt. I'll now move on to the domestic exemption. Next slide, please. So the finance bill that was introduced quite recently, as Neil mentioned, pretty much entirely rewrote the domestic exemption piece that was previously in place. And whereas previously the understanding was that the exemption would be provided on domestic transactions quite broadly, as is the case in many other jurisdictions, where we are now is a quite narrow and quite restrictive exemption that seems to be in place. And I would say probably one of the more onerous domestic transfer pricing regimes in Europe, at least. So what we've now have in place is, and I've given two examples to illustrate this, is that the companies are precluded from applying for the exemption or accessing the exemption, other than for certain loan transactions, when the consideration payable between related parties is not greater than a nominal amount. Also, there's quite specific criteria even for loan arrangements to access the exemption. So in the example on the left, we have a parent company lending to a holding company, which then doesn't directly engage in a trade. Our understanding is that to be a qualifying loan arrangement, the borrower either has to be carrying out a trade or having Irish rental income, either of which chargeable to tax, or it has to be holding shares directly in a trading or rental company that's doing one of those points. So in the example here, Holdco 1 will not be able to access the domestic exemption. Holdco 2 may be able to, but that's also subject to restrictions. For example, in this case, it must be in receipt of dividends above a nominal amount, again, that concept of nominal, within a 3-year period. And that's all going to be in place and applicable for chargeable periods after 1st of January next year. There were a couple of committee stage amendments that have come through that are slightly helpful. First of all, one allowing where you've got a loan to a holding company that's used to repay an original loan, and the original loan would have qualified. That seems to be now something that may be considered a qualifying loan arrangement. And in the other case, if one has a debt left outstanding, so rather than a loan, if you've ended up owing money as a result of an original supply of goods, services, or other assets, then that may also be treated as qualifying. But all in all, this is a very complex, quite restrictive domestic exemption arrangement, probably one of the more difficult ones in Europe. And I think our feedback, as Neil has mentioned, is that this is really something that needs to be looked at afresh. So Neil, back to you to sum up.
Sure, thanks, Ian. Just if we move on to the next slide, I guess it was really just an opportunity to remind people of what our key takeaways, and I think they're reasonably straightforward or simple takeaways. You know, some interesting stuff there from Noel and Ian, just in terms of you know, have people I guess reflected their current state of their business in their transfer pricing policies. And I guess that's our first takeaway, which is do you have a transfer pricing policy that truly reflects how your business is creating value and managing those risks that Noel spoke about. And I guess I would say that it's important to understand that, you know, two businesses that may on the face of it appear to be directly competitors may create value in two very different ways. That's takeaway point one. I think the second point we would notice is does your transfer pricing documentation tell a strong story? And what we mean by that is we think that there's an opportunity through your transfer pricing documentation to be able to, you know, put a strong narrative forward in terms of how your business creates value and how that applies to your transfer pricing policy. I think what we've seen far too often is where that hasn't been done well. It gives an opportunity to taxpayers to, sorry, I should say to tax authorities to assert fairly aggressive positions and I guess unpick the facts as they see fit. So what this does is, I guess, is it gives you a good chance to be on the front foot to set out your own stall in terms of the application of your transfer pricing policy to your own business and explain it on your terms. And I think that is an extremely important thing, I guess, to have in place if and when an audit arises. I think thirdly, and this is one that we will talk about a bit more on our next session, is what is your strategy to manage and resolve transfer pricing disputes? Have you worked one out? Does that involve investment in a strong documentation and to be able to tell that story? Does it involve APAs, so advanced price agreements, whereby you might be able to real-time agree your transfer pricing policy between tax authorities? We are seeing groups considering the use of not only bilateral APAs but multilateral APAs involving various jurisdictions, I guess, to try and avoid the situation of protracted audits, costly audits, taking up a lot of time, not only of finance and tax functions, but also the wider business when it comes to having to, I guess, explain that to tax authorities. And then the last point is really more a point of note, which is don't forget that tax audits happen retrospectively, right? Probably a fairly obvious point to mention. But the reality is that these things do happen retrospectively. And when a tax authority comes along and initiates an audit, it often is in respect of something that happened 4 or 5 years ago. And really the question then is well, do we have the evidence captured going back 3 or 4 years to be able to, I suppose, support our policy and support our position on the application of that policy? And often it can prove to be quite difficult to do that to the extent that you haven't had a process in place to capture that evidence. And I think just as part of that, on the next slide, I had left a bit of sage advice for people to reflect on, because it wasn't raining when Noah built the ark, right? So that's something for people to take away and have a think about. So just, I'm conscious that we're quite up on time, and we did promise that we'd try and get you out of here in 40 to 45 minutes. And just looking to see if there's any questions coming through. There's one, maybe I'll throw one out, which is, I see, you mentioned doing an in-depth assessment of how the business creates value and manages risks. Is the view of the panel that it's worthwhile exercise investing in, or are you better off waiting until an audit arises and dealing with it at that point? I might throw that to you, Noel, maybe just given that it sort of hits on what you were talking about.
Okay, thanks, Neil. Yeah, I think it's kind of coming back to what you were just concluding with there. It is about putting your best foot forward, and I wonder how capable a taxpayer is doing that if you're starting from scratch when you get an audit notification from a tax administration. It's worth saying, like, our documentation requirements now in Ireland, and it can differ by jurisdiction, but ultimately Ireland now has a contemporaneous requirement. So it used to be the question, can you take this reactive approach, or are there circumstances where you should be proactive? I think the question is changing now, and ultimately, if you want to qualify for penalty protection, as an example, so Ireland has tax geared penalties where your penalties can be as high as 40% in the case of careless behavior. I think Irish Revenue are saying where you can demonstrate that you have taken reasonable efforts and you're not waiting until an audit assessment to comply with documentation principles, that they'll look favorably on that in the event of an audit adjustment and perhaps mitigate any risk of a penalty adjustment. So there's a couple of different factors there, but I think right now it has moved to being much more proactive and really having documentation at the time your tax return is due to be filed.
Yeah, very good. I see one more coming in, which is fairly to the point, which says, what's the latest on the domestic exemption? Will it be changed? And what does the notional amount mean? So there's a lot in that question. I might take that one myself. I guess, as I mentioned at the start, there is quite a bit of representation into the Department of Finance and Irish Revenue on the domestic exemption, and I guess what it really is seeking to achieve. Those narrow changes to the law that Ian referred to only came out a few weeks ago. So I think we are in the midst of seeing whether there will be any flexibility, I guess, in terms of the Department of Finance and Revenue's view, and whether it was inadvertently capturing some transactions. But I think that's a kind of a wait and see. I think we'd expect to have an update on that fairly quickly in the next couple of weeks, and should be able to update you on our next session. I think with with regard to the question of what does a notional amount mean, it's a very good question. That, I guess, is probably causing a lot of the difficulty with some of the laws it's written. There is no definition of what a notional amount is. Question mark, is there a concept of relativity when we talk about amounts? A notional amount in the context of a loan that is €100,000 is different to 5 billion euro. And so I think taxpayers are going to need some guidance on that, if to the extent that the law remains the same. So I think, just given I had promised to try and keep us to the 45 minutes or 50 minutes, I think we might call it at that. There are a couple of other questions, but I think it would probably overrun on time. So I think it probably just leaves it to me in closing to say thank you to you all for your attendance and participation. I hope you found it useful. We will circulate this recording to you all again after this session. My sincere thanks to Noel and Ian, who I think are only scratching the surface on these issues in terms of their areas of expertise. I'd say a reminder that we will have the other session. It'll be likely in the new year, where we get into more advanced aspects of that quantum of debt point, which is really a significant thing for taxpayers thinking about at the moment, and just how to approach that in a more sophisticated look at the analysis, I think. And also, I think the Irish to Irish exemption would certainly be worth revisiting when we have a bit more colour on that. So that's it from us. Everybody have a good weekend, and thanks for your attendance. Goodbye.
Bye.
Thanks. Bye-bye.